Welcome, curious minds, to The Deep Dive. Today we're diving into something, well, truly fascinating. We're exploring Japan's economy, but maybe not in the way you usually hear about it.
That's right. We're digging deep into Richard Werner's book, Princes of the Yen, which presents a pretty radical view of how Japan's economy was shaped.
It really does. Forget the usual story of free markets. This book argues that behind the scenes, a powerful elite, kind of hidden within the central bank, was pulling the strings.
Yeah, orchestrating everything from the post-war boom, the so-called miracle, all the way through to that long, painful recession in the 90s.
And apparently, with a very specific long-term agenda to completely reshape Japan. Because, well, it's a story about power, control, and maybe money working in ways we don't fully grasp.
Exactly. It challenges a lot of assumptions.
Okay, so let's kick this off by tackling that common image of post-war Japan. You know, the economic miracle, everyone thinks free market triumph.
Right, the standard narrative. But Werner just throws that out the window. He basically says, hold on, Japan's post-war economy wasn't like a war economy.
It was one?
Pretty much, yeah. A fully mobilized war economy, just repurposed. Instead of tanks and planes, they started churning out cars, TVs, consumer goods.
Wow. Okay, that's a huge claim right there. So how does he back that up? We need context, right?
Definitely. You got to look back to the 1920s. Japan back then was actually much closer to pure laissez-faire capitalism.
Really? How so?
Well, you had faster hiring and firing, real trade unions fighting for workers, companies owned mostly by individual shareholders. A very different vibe.
Okay, so a more classic capitalist setup. What changed?
The Great Depression hit Japan hard. Really hard. We're talking widespread poverty, even starvation in rural areas. And get this, by the early 30s, military physicals found tons of young men unfit for service, malnutrition, health issues from rough jobs. It was bad.
So a real crisis.
A profound crisis. And the elite, the people in charge, they saw this and thought, okay, this free market thing, it's not working for national strength. We need something different, something more controlled.
Right. Survival mode kicked in.
Exactly. And that set the stage for a massive transformation driven largely by the military, especially between 37 and 45. They used wartime emergency laws as cover.
Cover for what? Exactly.
Building this mobilized economy. Law after law tightened the state's grip. Like the 1937 export-import law that basically said, forget consumer goods, materials go to munitions.
Controlling resources.
Totally. Then the emergency capital allocation law controlled how companies could raise money, pay dividends, basically forcing all investment towards the war effort.
So directing the money flow.
Precisely. And the big one was the National General Mobilization Law of 1938. That gave the government insane power. Mobilize anything, draft anyone for work. Bureaucrats got a blank check.
Wow. Total control.
Pretty much. And this all came together in 1940 with the new economic order. Wasn't just tweaking things, it was a whole new financial system, new fiscal policy, even a new labor system.
A complete overhaul. Who ran it?
The Cabinet Planning Board. Think of them as the economic generals, mapping out the strategy, making sure resources went to the right industries for maximum growth.
And how did they view companies in this system?
That's key. Not as profit seekers, but as farmers of the economy. Their job was to grow, to reinvest, not pay out dividends. Corporate savings were prioritized over shareholder payouts.
Right, feeding the war machine or later the growth machine.
Exactly, which led to this radical idea, separating ownership from control. The reformers basically said, capitalism works better without capitalists interfering.
Without shareholders getting in the way.
Yeah. Managers became powerful, like private sector soldiers taking orders from the bureaucrats, they got sidelined. Dividends were slashed, capped first at 10%, then down to 5% by 44.
And eventually,
laws like the Munitions Corporation Law just cut shareholders out of management entirely. Managers answered only to the planners about hitting production targets. The company became a communal organization for its workers, not shareholder property.
And the workers. What about this new labor system?
Also from 1940. This cemented things like lifetime employment, pay based on seniority, and company unions, which were often just extensions of management.
The system we associate with post-war Japan.
Exactly. Employees became corporate soldiers, loyalty to the firm above all else. So by 1945, when the war ended, the blueprint for post-war Japan was already there. Low job mobility, High loyalty, weak shareholders, banks calling the shots on funding, powerful bureaucrats directing traffic, and a workforce used to intense schedules.
Not exactly a free market blossoming after the war then.
Not even close. It was a deliberate wartime creation.
Okay, this is where it gets really wild for me. So the war ends, the U.S. occupation under MacArthur comes in, aiming to democratize, break up the big conglomerates, basically install American-style capitalism, right?
That was the official plan, absolutely. Demilitarize, deconcentrate, liberalize.
But the book says, what? That just didn't happen to the economic structure.
Pretty much. Werner's claim is stark. The core wartime economic controls essentially stayed put. It was like a magic trick reform by relabeling.
Relabeling. How? Give me an example.
Okay, the munitions ministry, the absolute heart of the war economy. Did it disappear? Nope. It just split and got new names. MIT, Ministry of International Trade and Industry, and the Economic Planning Agency.
MIT. Everyone knows MIT was key to Japan's post-war success.
Exactly. But its origins, its DNA, were in wartime control. Same function, less scary name. And those wartime control associations that dictated things for each industry.
Yeah.
They just became post-war private sector business associations. The Japan Automobiles Manufacturers Association. Literally the wartime car control body. The big umbrella group, the Kaidanren, direct descendant of the Wartime Economic Command Center.
That's incredible. So the institutions just put on new clothes. What about the people?
That's maybe even more stunning. The people running the war economy, the bureaucrats, the managers, they mostly stayed. MacArthur ruled indirectly, using the existing Japanese bureaucracy.
So the architects of the war economy were left in charge.
Largely, yes. Their main rivals, the military, the powerful home ministry, were gone. So, arguably, the economic planners became more powerful after the war.
You're kidding.
Nope.
Yeah.
Key war planners, the elite who designed this system, including guys involved in managing occupied Manchuria, they became post-war leaders. Nobusuke Kishi, wartime munitions minister, a key architect, later became prime minister.
Wow. Okay. And the big industrial groups, the Zaibatsu, weren't they supposed to be broken up?
They were targeted, yeah. But the Keiretsu system, these networks of companies linked through cross-shareholdings and a main bank, largely survived and even thrived. The main bank system, where banks held shares in companies and directed lending, that stayed too.
So the core structure remained.
And cartels. Far from being dismantled, they actually grew, from like 160 in the mid-50s to over 1,000 by the mid-60s. They weren't focused on profit competition. It was about maintaining market share rankings, supposedly for the public interest.
Okay, so the miracle looks less like a miracle and more like continuity.
Yeah.
A repurposed war machine.
That's the argument. And this model, well, it worked almost too well in some ways. These companies, still driven by that wartime market share all-costs mentality, kept competing ferociously. Not for profits, but for dominance.
What do they call that? Excess competition.
Exactly. Kachuchush. Firms would fight till they were bankrupt to gain share. It was like an internal economic war.
And then they turned outwards.
And unleashed it on the world. Japanese exports, driven by this relentless market share focus, ignoring profits. They just hammered industries in the U.S. and Europe. Steel, shipbuilding in the 60s, then cars, then absolutely decimating U.S. consumer electronics in the 70s and 80s.
Causing huge job losses elsewhere.
Massive disruption. Werner connects this to a bigger trend he sees as sinister, the centralization of power, which he argues accelerated in the 20th century and continues now. It makes you wonder how much global competition is really planned economic warfare.
Okay, that's a completely different perspective on Japan's rise. Now, to understand the next part, the bubble and crash, we need to talk about something fundamental: money itself. How is it actually made?
Right. This is crucial. Most people think banks are just middlemen, right? You deposit money, they lend that same money out.
Yeah, that's what I always thought, like a loan broker for savings.
But that's not really how it works, or at least not for most money. The book uses the old goldsmith analogy. Remember them?
Vaguely. They held gold for people, gave out receipts.
Exactly. But then some realized they could lend out some of the gold itself, the stuff people thought was safe in the vault, while the receipts were still circulating as money.
Ah, so they created extra claims on the same gold.
Effectively, yes. They created new purchasing power. Suddenly, there was more money chasing goods than there was actual gold backing it. It was, you could argue, a kind of alchemy, or maybe even fraud, initially.
Okay. So how does that relate to banks today?
Because that's basically what banks do, but digitally. Werner points out over 90% of money today isn't cash from the central bank, it's book money, just numbers and computers.
So where does that come from?
It's created when a bank makes a loan. They don't check their vaults for deposits first. They just credit the borrower's account, creating a new money essentially out of thin air.
Wait, seriously, they just type it in?
In essence, yes. The loan creates the deposit. So the critical insight is banks create and allocate the vast majority of purchasing power in the economy. Understanding this changes everything.
Wow, okay. My mind is slightly blown.
It's a big one, and historically, many missed it. European rulers obsessed over gold and silver, thinking that was the only real money. But Chinese emperors back in the 10th century already got that money, was about state decree, a tool.
So our modern focus on M1, M2, interest rates, that's missing the point.
According to Werner, yes. He argues they're misleading. The real driver is the quantity of credit creation, how much new money banks are actually creating through lending. Interest rates can be low, but if banks aren't lending, the economy stalls.
It means this idea of a savings shortage holding back investment
Is a myth, he argues. Banks don't need pre-existing savings to lend, they create the money to lend. And that lending creates the deposits, which we then call savings. Need more investment. Banks can fund it by creating credit.
Okay. But surely how that created credit is used matters.
Absolutely crucial distinction. Werner talks about productive versus unproductive credit creation.
Productive is.
Credit used for things that actually increase the output of goods and services, building a factory, developing new tech, funding a business expansion. This doesn't cause inflation because you're creating more stuff alongside the new money. Supply meets demand.
Got it. And unproductive.
That's credit used just for consumption or critically for bubbles, for speculation. Buying existing assets like stocks or real estate, hoping the price goes up.
So more money chasing the same amount of assets.
Exactly. That drives up asset prices. Asset inflation, a bubble, or if it's chasing consumer goods, you get regular inflation. It doesn't create real new wealth, just inflates values.
So if private banks create most of the money, what's the central bank, like the Bank of Japan, actually doing? How do they control anything?
Great question, especially since the Bank of Japan, BOJ, always seemed, quiet, officially under the Ministry of Finance, pretended it didn't have much power.
But the book says otherwise.
Completely. It says, in practice, the central bank ruled Japan. And this book is supposedly the story of how they used and misused that power.
What tools did they have beyond just interest rates?
Think back to the German Reichsbank. They pioneered something called window guidance back in the 20s to 40s. It wasn't about the official interest rate you heard about. That was just PR.
So what was it?
Direct, behind-the-scenes instructions to banks on how much they could lend and often who they could lend to. Strict quotas, extra legal, but powerful.
And the Bank of Japan did this too.
Absolutely. They were the control center. They literally classified industries. A for top priority, like war supplies or later key export industries. B for medium. C for low priority stuff like luxuries.
And they told the banks where to lend.
They assigned main banks to key companies and used window guidance to ensure credit flowed to the A-list sectors and was restricted for the C-list, like real estate speculation or fancy imports.
So they were actively shaping the economy through credit allocation.
Precisely. That's why growth was so high in targeted sectors. They starved unproductive areas and force-fed the strategic ones. Werner argues this control was a major reason for Japan's post-war success. The banks were the general staff directing the total war of high economic growth.
A command economy run through the banks, essentially.
You got it.
Okay, so we have this picture of a tightly controlled economy directed by the Bank of Japan using credit. How does that lead to the insane bubble of the 1980s? It seems counterintuitive.
It does, right? But the 80s started getting weird. Suddenly, Japan is the world's biggest capital exporter, like money pouring out.
I remember hearing about Japan buying up the world.
Exactly. Japanese foreign investment exploded. In '87, it was almost double their massive trade surplus. They were investing way more abroad than they were earning.
Where was it going?
Mostly portfolio stuff, especially bonds. Get this. In 1986, they bought something like 75% of all U.S. Treasury bonds auctioned off. They became America's banker, basically.
Okay, huge outflows of capital.
Yeah.
So the yen should have weakened, right? Economics 101.
That's what everyone thought. But, and this is the great yen illusion, Werner talks about the yen strengthened massively, up over 100% against the dollar between 85 and 87.
How is that possible? It baffled economists.
We'll connect it back to credit creation. The argument is Japan wasn't just investing savings, they were effectively creating new money, hot money, partly by borrowing foreign currency and then buying up the world.
So the outflows weren't draining the domestic money supply in the way people thought.
Seems not. And domestically, this fueled the bubble. It was classic resource misallocation banks creating excessive credit, but channeling it into unproductive speculation, mainly real estate and stocks.
Why real estate specifically?
Japanese banks loved land as collateral, especially after a banking crisis back in the 20s. So as land prices started inching up, banks felt safer lending more against it.
Creating a feedback loop. Higher prices, more lending, even higher prices.
Exactly. A self-reinforcing speculative cycle. Werner tells stories of loan officers basically chasing small property firms, begging them to borrow more, promising guaranteed capital gains. Loans way over normal property values became common.
So reckless lending fueled by rising asset prices. How big did this get?
By 1989, these bubble loans to real estate, construction, and finance companies lending to speculators were like 27% of all loans, a quarter of Japan's GDP that year. Huge.
I never just thought Japan was rich.
The average person called it kinamari, excess money. They saw it. But the experts, maybe not so much. The key was that this money wasn't causing massive consumer price inflation because it wasn't chasing goods.
It was chasing assets, stocks, land.
Bingo! Creating asset inflation. The bubble. And Werner stresses this isn't unique to Japan. Same basic story. Credit bubble fueling speculation happened in Scandinavia, the UK, US mortgage markets in the 80s, later in Asia, the dot-com boom. It's a recurring pattern.
Until it bursts.
Until it bursts. Because, as the book says, in the long run, credit creation that is not used productively cannot be paid back.
So the crash came. What happened then?
Disaster. 100 trillion, a fifth of GDP in bad debts. Banks were paralyzed, saddled with loans that would never be repaid because the asset values collapsed. They stopped lending.
Credit crunch.
Massive credit crunch, rising unemployment, the worst recession since the war, the 7 lean years, which turned into more like a lost decade or even 2.
And nobody saw it coming.
Experts were still talking about Japan taking over the world. The length and depth of the recession shocked everyone.
But here's the real puzzle of the 90s, right? They had deflation, unemployment. Why doesn't the Bank of Japan just flood the system with money to get things going again?
Exactly. The government threw money at it, huge stimulus packages. The BOJ cut interest rates to basically 0.
Yep.
Standard playbook stuff.
Man.
It didn't work because, Werner argues, those things don't help if banks aren't creating credit. You can make money cheap, but if banks won't or can't lend, no new purchasing power gets into the economy. The pipes are clogged.
Okay, that makes sense with the credit creation idea. But then comes the really explosive claim.
Yeah, this is where the book really lands its punch. It claims the recession wasn't just bad luck or bad policy. It was intentional, that the BOJ chose to prolong it using its control over credit.
Deliberately kept the economy weak. Why on earth would they do that?
Well, that leads us to the alleged master plan and the princes behind it. So, if the BOJ deliberately prolonged the recession, who are we talking about? Who is making these calls?
This is where the princes of the yen come in, right?
Exactly. The book names names. Miyano, Fukui, Maekawa, Sasaki. These weren't just random governors. They were supposedly anointed future heads of the Bank of Japan, groomed for power, ensuring policy continuity over decades.
10 years each at the helm, it says.
Roughly, yeah, in top positions. And crucially, they were also involved with this influential business group, the Kezai Duchikai.
What's their significance?
Since the 70s, this group had been pushing for radical structural change in Japan, deregulation, liberalization, basically moving towards a more American-style market economy.
Okay, so these BOJ guys were linked to that agenda.
Deeply. And the core allegation is that they used their power over monetary policy, distorted it even, specifically to force these structural changes onto Japan.
Using the recession as a tool.
That's the claim. It highlights Miyano, governor during the bubble burst and early recession, and Fukui, head of the banking department during the bubble's peak, as key players.
But how could they control things so precisely? Didn't they stop window guidance, those direct lending controls?
That was the official story. Everyone thought it ended in the 70s or early 80s, but Werner says, not so fast. He claims he found the smoking gun.
Which was?
Internal BOJ documents, interviews with actual bank officers, apparently confirming window guidance never stopped. It was still a binding procedure right through the 80s bubble.
Wait, so the BOJ was still telling banks how much to lend, even during the speculative frenzy?
Yes, and get this. Sometimes the quotas were too high for the banks. They didn't want to lend that much. But the BOJ, especially in 86, 87, was apparently pushing them, use more, lend more.
Why would they do that if they knew it was fueling a bubble?
Banks felt forced to use the quotas to keep their ranking, to not look weak. The implication is the BOJ knew it was fueling the bubble, perhaps even encouraged it, using this extra legal tool.
Playing the economy like a yo-yo, as the book says.
Exactly. Inflate it with high quotas, then pop it by slashing them. And the goal wasn't just BOJ independence. It was much bigger. It was the total structural transformation of Japan's economy. The bubble and crash were the means to that end.
That is a deeply cynical view of central banking. So while this is happening, what about the Ministry of Finance? They used to be all-powerful.
They became the fall guy. Public anger over the endless recession focused squarely on the MOF, the courage. Their reputation was ruined.
I remember hearing about raids and arrests there.
Yeah, unprecedented stuff. Prosecutors raided the ministry, senior guys arrested, some committed suicide. And then in 2001, the ministry itself was basically dismantled, broken up.
And the Bank of Japan
came out smelling like roses. They got their full legal independence in 1998, separate from MOF, separate from everyone. The crisis they allegedly engineered gave them the political cover to achieve their long-term goal.
Wow. Okay, so what was this structural transformation they wanted so badly they'd allegedly crashed the economy for it?
The thinking, supposedly, was that Japan's old war economy model, focused on maximizing inputs pouring in labor, capital was hitting a wall. Growth rates were slowing down sharply from the 70s onwards.
Running out of steam.
Yeah. They needed a new engine, the solution. Shift from input maximization to productivity. Japan was efficient at exporting, sure, but overall productivity was kind of low because the domestic economy was protected, cartelized, inefficient.
So they wanted to just shake things up.
Big time. Introduce U.S.-style capitalism, liberalization, deregulation, privatization, break up the old system.
Almost specifically.
Shift from bank-led finance to stock market-led finance, and the cozy blanket deposit guarantees for banks, maybe even privatize the giant postal savings system, encourage stock investment.
Remake the whole financial architecture.
And a key technical change, market value accounting, brought in around 2001. Sounds boring, but it was huge.
Why?
It forced banks to value their assets, especially stocks they held in other companies, at current market prices, not the price they paid years ago. In a falling market, that meant recognizing huge losses.
Which forced them to sell those shares, breaking up the old Keiretsu cross-holdings.
Exactly. Accelerating the shift to shareholder capitalism, where managers focus on profits for shareholders, not the old stakeholder model. The recession, Runner argues, created the mood for this. It shattered faith in the old system and made people desperate for change.
So the controversial hypothesis is they needed the crisis.
That's the core of it, that the BOJ's specific monetary policies creating the bubble, then prolonging the slump, were seen by the princes as the only way to break the old system and force through these reforms. They feared that easing policy too soon would just take the pressure off.
Using economic pain as a political tool, that's chilling. It really is. And it brings us back to that puzzle. Why didn't all the stimulus and zero interest rates work in the 90s? Mainstream economics was stumped.
And the book's answer is, those models were flawed. They didn't properly account for credit creation by banks, and crucially, they ignored all the money sloshing around in non-GDP transactions like asset speculation.
They were looking at the wrong indicators.
Or only part of the picture, yeah, like trying to diagnose an illness by only taking someone's temperature.
Okay, so this whole story raises massive questions about central bank independence, doesn't it? We're always told it's crucial for good economic management, low inflation.
That's the dogma, yes, especially in Europe, underpinning the euro. But Werner slams the evidence for that. He cites research, particularly by John Forder, claiming the key studies supposedly proving the independence low inflation link were based on, well, manipulated data.
Manipulated, seriously.
That's the allegation. Forder apparently reanalyzed it and found no robust link. So the intellectual justification for making central bankers unaccountable might be built on sand.
Yeah, the danger of that unaccountability.
Werner draws a direct and scary parallel to the pre-WWII German Reichsbank. Legally independent from the German government, but influenced by foreign bankers, he says.
And they caused.
First hyperinflation, then brutally tight money policies that caused mass bankruptcies, using those same kinds of extra-legal credit controls as the BOJ, creating misery that helped extremists rise.
Oof, that's a heavy comparison.
He contrasts it with the post-war German Bundesbank, whose success came from accountability and consensus despite its power. They weren't totally independent gods. They had to operate within political reality.
And the European Central Bank today?
Werner sees it as dangerously unaccountable. Far more independent than the Bundesbank, he says, and maybe the least accountable major central bank. The Maastricht Treaty basically forbids politicians from telling them what to do. He calls it a revival of the unaccountable Reichsbank.
So he sees a direct line of dangerous, unaccountable central banking from the Reichsbank to the early Bojay governors and then to these princes in the 80s and 90s.
That's the bleak picture he paints. Unaccountable power leading to human misery time and again.
So if the standard policies failed, and the Bojay was maybe even making things worse, what should Japan have done back in the 90s, according to this book?
The prescription is pretty radical. Aggressive expansion of credit. Basically quantitative easing on steroids long before it became fashionable.
How aggressive? What should the Bojay have done?
Buy everything. Not just government bonds, corporate bonds, stocks, foreign currency, even banks' bad debts. Buy them at face value to recapitalize the banks instantly.
Buy bad debt at face value. What about moral hazard?
We'll get to that.
Yeah.
He even suggests the Bojay buy real assets, like literally buy up land and build Bojay parks in Tokyo to inject cash directly.
Central bank becoming a property developer. Wow. What else?
Lend directly to companies. And maybe the most eye-catching, transfer money directly to taxpayers. Helicopter money.
Just give people cash.
Yeah. And have the government fund itself by taking bank loans instead of issuing bonds. Because bank loans create new money, remember. Bond sales just move existing money around.
So focus entirely on boosting credit creation and how to stop this happening again.
Make central banks truly accountable to Parliament. Set clear targets like for nominal GDP growth and impose real penalties on the central bankers if they fail to meet them. No more hiding behind independence to pursue secret agendas.
Okay, back to that moral hazard point. Wouldn't bailing out banks who made bad loans just encourage more bad behavior?
Werner flips that argument. He says the banks weren't just being reckless, they were acting as agents of public policy under Bojay orders via window guidance during the bubble.
So if the Bojay ordered the lending, the Bojay should pay for the cleanup.
Exactly. The principal should bear the cost, not the agent. Punishing the banks creates the wrong kind of moral hazard, discouraging them from following guidance in future.
That's a clever twist on it. Does this story have wider implications beyond Japan?
He connects it to the Asian financial crisis in '97. Remember the Asian tigers? Miracle economies, everyone said.
Yeah, Thailand, Korea.
The book claims their crisis was also triggered by policies recommended by the U.S. Treasury, IMF, and local central banks. Rapid liberalization, deregulation, borrowing foreign money. Sound familiar?
Very. And what happened after their crisis?
Their central banks also gained more independence. And Werner suggests the princes from Tokyo weren't just watching. He points to this exclusive club, EMEEP, formed in '91 East Asian central bankers, with Bojay initially running the show.
What were they up to?
The alleged long-term goal, an Asian currency union, suggesting these networks of powerful, unelected central bankers have regional, even global ambitions far beyond just managing national inflation rates. Hashtag tag outro.
Wow. Okay, we have covered a lot of ground today. This deep dive into princes of the yen really does turn conventional economic history on its head, doesn't it? From that view of Japan's post-war growth as a repurposed war economy.
Yeah, to the idea that banks literally create money and how controlling that creation gives central banks immense, often hidden power.
And then the really unsettling claim that this power was used, allegedly, to deliberately engineer a boom and a prolonged bust in Japan, all to force through a specific structural reform agenda.
It fundamentally shifts how you might see central banks not just as neutral technocrats, but potentially as incredibly powerful, unaccountable players shaping our societies.
It certainly makes you look at economic news and history very differently. The idea that so much could be happening behind the curtain.
It does, and the insights here really compel you to question those widely held beliefs, not just about Japan, but about our own economic systems. Who really holds the power? How much is truly driven by free markets versus deliberate design?
And it leaves us, and you listening, with some big questions, I think. Given how much impact central banks have on our jobs, our savings, our futures, how much accountability should we actually demand from these powerful, unelected figures?
Exactly. What responsibility do we have as citizens to try and understand these complex systems, even when they're deliberately opaque? And maybe, just maybe, to question the official narratives we're given when economies go sour or when bubbles suddenly appear. It's definitely something to think about.